million paid on 1st April 2017. The retained earnings balance of Twende Limited as of the date stood at 870 and had no other reserves. Draft financial statement of the two group of companies for the year ended at 1st March were as set out below. So you have the income statement, profit or loss, Kuja, Twende, and statement of financial position. Additional, a fair value exercise carried out on 1st April concluded that the carrying amount of Twende Limited net assets approximated their fair value. Exemption of an item of land and equipment which had a carrying amount of 100 million below its fair value as at 1st April 2017. The plant and equipment had a remaining economic useful life of 10 years. Depreciation is charged to cost of sales. It is a group policy to measure non-controlling interest at the fair value at the date of acquisition. The fair value of non-controlling interest in Twende in April was estimated at 1370 million. Kuja Group adopts revaluation model to measure its property, plant and equipment as permitted by IAS 16 BPE. Revaluation surplus reported by Twende Limited relates to the revaluation conducted in the post-acquisition period. During the year ended that 1st March, Twende Limited sold goods worth 200 million to Kuja Limited. Twende Limited reports a gross profit markup of 25 on all its sales. Kuja Limited still had 25% of these goods in its inventory as of the 1st March 2022. As of the 1st March, Twende Limited records showed a receivable due to Kuja of 140 million, which corresponds to the balance in Kuja Limited trade payables. An impairment review conducted on that 1st March 2022 revealed that goodwill arising on acquisition of Twende Limited was impaired by 10%. No impairment loss had been reported in the prior years. So you require group statement of profit or loss, another comprehensive income, and group statement of financial position. Not only that, it's a group account. This is August 2022. Question number 2. And number 1, we need the group statement. So Kuja Limited. The limited group statement of comprehensive group statement of profit or loss. Profit or loss. Another comprehensive incomes. Here and then the 1st month 2022. So we say the first thing we deal with workings. Our first working is the group structure. So we are having Kuja acquiring what? Twende. So we acquired which percentage? 70%. The balance will be for NCI. Remember that? NCI of cash. So Twende will be our subsidiary. In the wrong class. Yeah. Okay, so subsidiary. When did you acquire Twende? The date of acquisition 1st April 2017, and we are reporting on
that 1st
March. Those how many years? Since we acquired it? Are they 4? 5 years, huh? Yeah, 5 years. Okay. So you go to number 2. So that was a subsidiary and you acquired it several years. We deal with goodwill. Goodwill on acquisition. Our purchase consideration was? Yeah, that one we have been given an amount of 36. The fair value NCI? Have given in what number? Number 2. The group policies to measure non-controlling interest at fair value at the date of acquisition. The fair value of non-controlling interest in Twende on 1st April 2017 was 1370. When you add? You get 49?
It's 970.
Yeah, less net assets. Net assets acquired. Net assets acquired. Ordinary shares, we had a value what? The statement of financial position. Ordinary for 20, 3,000. Huh? And 3,000. Our retained profit. We say retained profit, we use a pre-acquisition. By the time of acquisition, at the beginning, we had 870. Have you seen that, Mara? Yes. 870. And you're told we did not have any other reserve. When you read at the beginning, they had 870 and had no other reserves. But not number one, we have fair value. Fair value gain of? You note number one? You are told the items, total limited net assets approximated their fair value with the exemption of item of plant and equipment which had a carrying amount of 100 million below its fair value. So was it a gain or a loss? Was it a gain or a loss? Not one. But they are saying that a fair value exercise carried out in April concluded that the carrying amount of total limited net assets approximated their fair value with the exemption of an item of plant which had a carrying amount of 100 million below its fair value. Is it gain or loss? Gain. Why? It's below. So remember they are talking about the carrying amount. And carrying amount we say is net book value. And we have fair value. Fair value. Fair value is the market value. When we talk about the fair value. Carrying amount is net book value. So carrying amount was 100 million below the fair value. So the fair value, in other words, was more by 100 compared to net book value. So we get again. Total? $39? 70. So you minus your goodwill? 1,000, huh? Goodwill impaired? It was impaired by what? The last note? 10%. 10%. So 1,000 by 10? 100. So unimpaired? 900. Goodwill unimpaired. 900. And you said unimpaired is an asset? Unimpaired is an expense, huh? Number 3, fair value depreciation. Fair value depreciation, it was for plan.
Yes.
We have said we had a gain of 100. How many years?
10 years.
10 years. So per year it was 10. When your portion 100 divided by 10 will be 10. Yes? Not 1. The number of years. You've seen it? Yeah. So that means when your portion holding will be 70. It should be 7 and NCI is 30. It should be 3. Accumulated depreciation. How many years? 5 years, which will be 50. Apportion that 70% and NCI 30. It will be that 500. This will affect statement of financial position. And this will affect income statement. Remember, income statement, we look at the profit for the year, the current year. But here we look at the accumulated for several years. So this item has been accumulated over 5 years. This is the last topic, then you consolidate. The one for intercompany, note number 4. During the year ended at 1st March, Trend Limited sold goods worth 200 to Kuja. The company sells. Here is Trend selling to Kuja. The selling price was 200. Yeah, 200 million. So we can create UPCS. You can remember UPCS and realize profit on closing stock. They sold it at a markup of what? 25%. 25%. Yeah, it was a markup, so 25. Over 125. It will give you what? Because it was a markup. 40. How much remained? Proportion that remained unsold. Kuja Limited still held what?
40 million.
No. Number 4. The last part. Kuja Limited still held 25% of these goods in the inventory. So that's the unrealized. 25%. Can give you 25 or 40. 10. 10. Your portion, because the person that will be reporting profit is 20. So 70% and NCI of 30. 7 and 3. I think that's all. Up to that point. So the others we shall come back then. So we start with our revenue. So we get a revenue of 51. We add 1920, it's a simple addition. Under the revenue, we minus the intercompany sales. The company sales. Get what? 1920, so remember in the income statement, look at the income statement values. Where they are. We are consolidating the revenue of India and revenue of 20. Let's say the two. So get what?
16 to
16?
20. 20.
Good cost of sales. Cost of sales. Cost of sales we had 40-50. Plus what? 11? 11-10, huh? For 20. Have you seen that? Cost of sales, huh?
Yes.
Kuja 40-50, 20, 11-10. We minus the intercompany. We normally minus in both. Because one company is a sales, the other company is a purchase. So we minusing from both, we add the UPCS. Our UPCS was 10, huh? And we add the depreciation of 10. Remember, ordinarily, depreciation is a cost of sales item. So we add the depreciation of 10 for the year, the one that is affecting the income statement, and the UPCS and realized profit on closing stock of 10. Can you give him? You will adjust that. Good enough. I'm not going to get it. Ask your question.
Cost of sales.
Uh-huh.
You less 20, avoid less 200, and then you add 20.
So remember, we are lessing the 200. 200 is the intercompany sales. We add 20, 10, 10. So remember, it's an expense. You can remember in published depreciation, we are adding it back. We are not lessing, we are adding to the cost of sales. The reference point published because
So
it's an
that's like
expense.
depreciation is charged on the cost of sales.
Yeah, were we minusing or were we adding? We were adding. We are not minusing. So you get what? 90. And the minus gross profit 18. 10, 14. So we move on to distribution. Distribution expense of 240. And we have got 210. Will give you 5 or 50. Then we have admin. Admin expense. Admin of 480 plus 230. We add the goodwill. The impaired of 100. Goodwill impaired is an administrative expense. Yeah, the goodwill impaired is an administrative expense.
810.
810. Get the operating profit. Operating profit. Right? 80. You had investment income. Did they pay dividend? They have not told us whether they paid any dividend. So investment income of 60. Less the finance. The finance cost of 85 plus 125. 210. So you minus that. Profit before tax. 530. Our tax of 175 plus 125 should give you 300. Relax. Profit for the year. Yes? 1840 minus 450 minus 810. You got what? Which one? So remember we are adding and minusing. Yeah, we are not taking it directly. So it will not be the same. Because of even 100. Yeah, profit for the year. Look at that. We had other comprehensive income. And the other comprehensive income we have the gain. Yeah, gain on revaluation. Gain on revaluation of what? On 80 plus 100. Should be true. 80. So total comprehensive incomes 510. And we less in CI now. NCI share.
So, the gain on revaluation is basically from the
statement of income statement, statement of profit or loss.
this one value of 100. This one does not affect anything.
No, it will affect the financial position.
Oh.
So remember already it has affected here. We have used it in calculation of goodwill.
Okay.
Yeah. So in number 5, the NCI share. NCI share of profit. So profit after tax in 20. When the profit after tax of profit for the year. Was it not 20?
Yes.
30%? What does it say is 30? You see that?
36.
36. Then, the lesson depreciation, deep on plant, our portion, it was 3, and in PCS our portion. Again we have 3. Remain with what? 30. So it is 30. Then we add share of revaluation. Share of revaluation. 20 had a revaluation of? Revaluation gain? Yeah, 100. Share of gain. Gain on revaluation. So 100 by 30. It will give you 30. So the total will be 60. Out of the total comprehensive of 510, 60 is for NCI. Attributable to holding? Holding company. What is the end of our income? Okay, so here is something. Before that, sorry. Let me less it here. Although you were supposed to less it here. But now what? Impairment, goodwill impaired. Goodwill impaired was 100, 30%. Which will be 30. So he will remain with what? Remain with that. So remember this goodwill that was impaired, that we are using full. And we wrote when we are using full goodwill, it belongs to both the holding and the NCI. So here it will be that. Supposed to less that. So here we shall have 0.8. We're done with the first part. Any question there? Here the second. The statement of financial position. Kuja Limited. Statement of financial. Group statement. Group statement of financial position. Financial position. As at 1st March 2022. So we start with non-current. Non-current assets. And the first one that we had is PP. Our PP we had 53 plus 50 plus the fair value now. Our fair value was 100. Then accumulated depreciation of 50. Yeah. The accumulated depreciation of 50. And the minus. Then we had investment of 45 minus what? Internally we had invested 30 To acquire 20? 36. So we eliminate that. Huh? We only remain the external investments. So 536? 900. And our goodwill, unimpaired. Which again we had 9? Total. Press start. That's 6 you have seen it, huh? 12,200. At a one? This on the side? Where does it reflect? Okay, sir. We go to current. Current assets. Is that an inventory? Inventory? Yes? The investment at the beginning, the acquisition consideration. At the beginning of the question, the amount that we paid, this amount that we used to calculate goodwill, the 36. So remember the total 45 was the total investment to 20 and other company. So we are minusing the internal one from 20 to remain with external. Okay. So inventory, we had what, 2840 plus 14, 15, 16. And we minus what? The UPCS. Remember that the inventory, we minus the UPCS, and our UPCS is 10. We will have what? 390. We go to receivable. Our receivables we had 2480.
Sir, before we continue,
Yes.
this 25%, who telling this goods in its inventory, it doesn't affect the inventory.
Which one now?
Number 4. Train there, in Chonda Limited, was a gross markup. Gross markup was 5% in sales. Kuja LTD still had 25% of these goods in its inventory.
Yeah. So markup, we got 40, 25% we got 10. This is the UPCS. And it is this one that is affecting. It reduces the value. No, already you have calculated it as a working. Receivable, 2480, 18. We minus what?
140.
140. Note number 5.
Yes.
140. The intercompany balances. We're calling the intercompany balances. So you get what? 4200. 140 note number 4. Note number 5. Yeah? Number 5, yeah. Further records showed a receivable due from Kuja of 140, which corresponds with the balance in Kuja Limited trades payable. There.
So this is a receivable to...
So one is a receivable, the other is a payable.
Payable to
So
Kuja.
they are saying that it showed a receivable due from Kuja. Due from. So we are receiving from Kuja. This one. So remember it is 20 that sold. It is because of this transaction of the company. So this one will receive. And this one will pay. So to Kuja is a payable. To 20 is a receivable. And that's why we are minusing that. Then we have cash. Cash and cash of 1780 plus 1030. Which will give you 2810. Total? 11?
100.
So when you add, and then there is 600. So you go to equity. Equity and liabilities. So start with the ordinary. Ordinary share capital. We said only the holding company.
Yes.
Yeah, we only consolidate it is share for share. Then we have share premium. Even this one, only the holding of other option. And we have revaluation. Revaluation of 1550. That one now we consolidate. 700 by 70. They have told us this 700. Look at note number 3. Note 3. Kuja Group adopts a revaluation model to measure its PP as permitted by I-16. Revaluation surplus reported by 20. It is this value now that was reported by 20. Limited relates to the revaluation conducted in the post acquisition. So it was not for pre. And that's why we did not include it under the net asset. It is a post-acquisition reserve. We take our portion of the post-acquisition, 70%. We'll get 90 plus this 19, 2040. So then we have the retained earnings. We shall do that as a working. We do it here. Working number 6 for the retained earnings. So put your head what? Or retained in the statement. What one? 170 and 20? 530 minus. Remember how you said you use what? The post. You can remember that. The pre was 870. This value that we used here, 870. It is at the beginning of the question. It's 70. 70% of that. 70%. So we are using post. So remember, 2530 is at the end. This is the total. It is inclusive of the pre. That's why we are minusing to get the post. So 2530 is the total cumulative value of the retained at the end of the year. It is inclusive of what? 870 at the beginning of the year. But remember, we need what? The post. So we are minusing 870. We get what? 70%? 1162. We have the goodwill impaired. Goodwill impaired. Our portion 100 by 70. 70. We have depreciation on plant accumulated. Our portion was for that what? 35 accumulated and UPCS. Our portion of 7 here for the holding. Get what? When you add 220 here, attributable to holding, 13 to 6. NCI share of net assets. So we do that as the last working number 7. NCI share of net assets. So we had fair value NCI of. Remember fair value NCI was 1370, note number 2. Yeah, 1370. We have the post acquisition profit. This one for project, because that's where we have the NCI. And 530 minus 870, 30%. The NCI share. One. 198. Goodwill impaired. 100 by 30. 30. Then depreciation on plant. Our portion was 15 accumulated. This one accumulated of 15 and UPCS of 3. B minus. Yeah, 15, 11. What is 11? 18, 20? Yes. 18, 20. 18, 20. When you add shareholders fund, 18. What is non-current? Non-current liability. And non-current we had 10% or not? The low one we had 17 plus 1050. Should give you 3750. And deferred tax of 740. You add 570. Total? 40? 1 current. Delete. Then payable. Payable to 340 plus 130 minus 140. Remember 140 that we minus in the receivable, we minus it here, we get 35. Then we had the current tax.
Why aren't we adding the 140?
Why?
Aren't we adding the 140?
So remember, we said we eliminated from both. One company is a receivable, the other company is a payable.
Okay.
So we are minusing from both.
Now increase the debt.
No, you minus, you cancel it out. Then we have 400 and. So remember, this one is paying. One company is receiving, and the other company has included it as a receivable. So one is paying us, it works as a payable. So here, Kuja has put it as a receivable. And Kuja has put it as a payable. So we had got on credit, so we shall pay. So it's part of our liability. This one, they have recorded it as part of the asset, receivable. They haven't received it. So it's an intercompany. So to do that, you cancel it. You remove it here, you remove it here. Because it's an intercompany transaction. The main aim is to eliminate it. 100 and 350. This will be 750. Total? 250. So you add. Anything? 990. A difference of? Must be an additional. Because I believe you have added everything. Difference of 210. So now we come to check this value. Because the problem can either arise here or under the NCI. Those two or any other addition. Just come to check on your 530, 70%, 162, 170, 220, okay. Here. Is it going to change? The button is going to change. But it was not going to change. What's our 1820? No, it's not. Okay, yeah, here. Evaluation. It's supposed to have their share. Remember here we only took what? 70%. Add here the share for the evaluation. So supposed to be under these, the evaluation. 700 by that. It should be 210. So this will be 20, 2030. So change here, 2030. It will be 15 to 90. 10 to 90. So you get 23,600. Yeah, that. So that's how that question was.